So well. Welcome to the next of our Essential series. I am delighted to be joined by Sarah Whitelaw. She is a US-UK tax advisor at Buzzacott, and today we're going to be exploring everything to do with your UK pensions if you are a US-connected woman here in the UK. Bit of a mouthful, but Sarah's going to deep dive into what that means for you and your money when it comes to your pensions. So welcome, Sarah. Thank you so much for being here. How are you?
I'm very good, thank you, Lottie, and thank you so much for having me today. It's a pleasure to join you.
You're so welcome. Well, before we kick off, it's always nice to know a little bit about who you are, what you do, and the types of clients that you traditionally work with.
Sure. I'm a partner in the US-UK tax team at Buzzacott. Buzzacott is a top 30 accountancy practice here in the UK. I've been at the firm for over 20 years now. Started as a grad, did my UK tax qualifications, then my US tax qualifications. And we're a team of over 70 individuals within Buzzacott who look after individuals, predominantly US citizens, US green card holders that are resident in the UK, helping them with their US UK tax return compliance and providing advice as required. We work closely with our in-house financial planning team and also corporate tax, where there are companies involved and things like that. But yeah, looking after a wide range of clients, really. Ones that have been in the UK for shorter periods and those that end up staying much longer term. So it's a real sort of mixed bag.
Yeah, and a lot of it is problem solving across the pond, effectively, because the rules are all ever changing, aren't they?
And so that's
it.
Yes, yeah. Mitigating double tax, really, and helping clients to pay as little globally as they have to. I think the US, as lots of you probably know, is one of the only countries in the world that sort of imposes a worldwide taxation on clients that aren't actually physically living in the US. So always lots of fun to keep up with the compliance and make sure that they're doing things as effectively and efficiently as possible.
Yeah, brilliant. Well, thank you. And, it's great to hear it from you as well. And being a woman working in this space, I think, is even better. But for everybody tuning in, if you're an American woman who has been living and working in the UK for several years, what is the fundamental pension picture that they would need to understand?
Yeah, well, I think, living and working here in the UK, it's highly likely that there's a pension element to the compensation package that someone has. So understanding what that means, both for UK tax purposes, because that's where it's all happening, but bearing in mind any differences in the UK tax treatment is clearly quite important. Just to run through a few UK basics in terms of what a UK pension means and how it operates. We get full UK tax relief on contributions that are made to a UK pension plan, up to certain limits depending on the level of someone's income. So currently you can put up to £60,000 into a pension per tax year. If you're a high earner, then that can be tapered down to a £10,000 limit. So once that money is in the pension, it grows tax-free, and then there's no UK tax until distributions are taken from that plan. I think the key things to be aware of differences in the US tax treatment are that the US will actually tax employer contributions to a UK pension. So it goes on to the tax return as part of your annual compensation. Employer contributions are those that are actually made directly by the employer, but they can also include those that are made by the employee if they're in a salary sacrifice arrangement. So that's something that it's not always apparent, and why would it be? Because the UK doesn't look to do that at all. But it's a certain thing that needs to be taken into account when preparing the US tax return. Equally, there may be a reporting required for the annual growth in value in that pension. So that also is a complexity that we see and have to take into account. And then tax on the distribution from the pension. So it seems like it's sort of tax with the US pension, but it's sort of keeping track of how that pension has been treated and reported on the US side throughout the period of contribution, and whether there's any basis in that plan that then isn't taxed again on distribution. And all of this sort of depends on where someone's resident at the time of distribution, and you may not know that at the time contributions are going in. So I think that, you know, it's certainly just, we need to be aware of how is the UK and the US taxing it as it goes along.
Yeah, well, absolutely. And I think, you know, people, and this is a big thing about pensions in general, and this concept of retirement, is that a lot of the time you just don't know where you're going to be. So having a plan that is flexible is pretty essential, especially if you are dual passport. And I guess looking at how the US treat UK pension arrangements, and how that wouldn't exist for a British colleague in the same workplace with those, the complications that arise from that.
That's right. Yeah, I mean, the sort of key concept here is that the US does not treat a UK pension as a qualifying pension for US tax purposes. So that's why there's differences in the tax treatment of a non-US pension plan versus that of a US pension plan, such as a 401k or an IRA. We typically see sort of two main types of pension plans here in the UK. You have some that are run directly by the employer, maybe a defined benefit scheme, or it can be defined contribution, but those are sort of increasingly rare as they're replaced by what we call personally funded pension schemes, which would be more like a group personal pension plan, or perhaps a SIP, a self-invested pension plan. And the first sort of question we're asking is, okay, well, how are contributions being made to that plan, and is it more than 50% funded by the employer? If you've got, I mean, I suppose most commonly we would see a group personal pension arrangement going into salary sacrifice. So in that scenario, as I mentioned before, salary sacrifice contributions by the employee are treated as employer contributions. So all of the contributions going into that plan are employer contributions. And in that scenario, the reporting is relatively minimal, I'd say, from a US tax perspective, other than having to include the contributions on the tax return and possibly the growth. I think it's worth mentioning there that, yes, whilst we have to include the contributions, clients may well have generated a pot of excess foreign tax credits in the UK that they can then offset against the US tax on those contributions. So foreign tax credit, you get a credit for any UK tax that you're paying on your salary via PAYE. And because the marginal tax rates in the are typically higher than those in the US, we've currently got a top rate of 45% versus 37% in the US. There's sort of a possibility that a client may not need all of those credits each year. So to the extent that there's any excess, that can offset pension contributions. And if that happens, then they create basis in the plan to take forward and take into account at the time of distribution. There's also the option to claim relief under the tax treaty between the US and the UK to take those contributions out of the US tax net at the time of the contribution. So if someone didn't have those foreign tax credits to hand when they needed them, that's an option too. So I think the treaty is obviously there to mitigate double taxation between the US and the UK, and it can certainly be used quite effectively when it comes to pensions. If the pension is not more than 50% funded by the employer, then we have what we call a personally funded pension, and there can be traps there if the pension is set up as a trust. That would mean that the pension itself is sort of looked through, and underlying income and gains that are realised within that pension can be brought out into the US tax net. So I know this probably all sounds quite complicated, and it can be tricky to navigate, and certainly, where sometimes the numbers involved aren't that high, but the fact is that that person is a US person. It's just sort of critical to get the reporting right and understand what it all means, and also be tracking it going forward, so that at the point of retirement distribution, individuals are clear on exactly what it means for them from a tax perspective.
Yeah, and that's something I think that, again, people overlook, is they don't actually realize what the net, proceeds will be from either an investment or a pension when it comes to when they need the money, and that is critical often. We've talked a lot about reporting obligations. Can you just explain a bit more about what they are that apply to US citizens holding UK pensions, and around forms? You've got things like the FBAR and the form 8938, all these brilliantly named forms. What are they? How are they used?
Okay, yeah. So the FBAR, that's the foreign bank account report that a US person is required to file if they have non-US accounts with a combined maximum balance exceeding $10,000 during the year. There's no tax due with that form, but it is submitted to the Treasury just as a report of each individual account, the account number, and the maximum balance. So most pensions would need to go onto that form and be declared each year. The exception might be for the employer sort of run pensions, such as the defined benefit, because it's not clear that that individual owns a segregated interest in those plans. And the 8938 form is actually part of the tax return, and it does duplicate the information on the FBAR and gets submitted to the IRS. So that's just more reporting. All pensions would have to go on that. So they're not complicated forms, but penalties for non-compliance can be high. So just making sure that everything is disclosed on that form as required.
Yeah, and that's it. And I think for a lot of particularly US connected people, it's the unknown unknowns. You get this concept of a resident alien or a non-resident alien and all of these things, and they just don't realize that they actually have to comply with these reporting obligations. And oftentimes that's when the complications can arise, which is when you have to come in and do some firefighting.
That's right. Yeah, I think when we take new clients on, it's sort of, part of the onboarding process is to review how things have been treated before, and, where things are at with the compliance. So there are options to correct things along the way if we see that. So it's not the end of the world, but it's just getting it right. That's what we're trying to do.
Yeah, definitely. You mentioned SIPs. What are they? You've sort of covered that effectively. But how are they treated under the US tax rules, and why has that been one of the more difficult vehicles for US clients to hold historically?
Yeah, so a SIP is a self-invested pension plan. So it's sort of, often we see those being used outside of an employer arrangement, perhaps, or where someone has moved an employer plan into a SIP. For non-tax reasons, perhaps, it gives greater investment flexibility. They can hold more of what they want to hold and not be restricted by certain funds being provided by providers. I think the issue we see with SIPs frequently is that they are classified as trusts from a US standpoint, and with a US owner of a foreign trust, so a non-US trust, there are some more forms to file annually on forms 3520 and 3520A. So what the 3520 form reports certain transactions within that foreign trust. So if you're contributing to the foreign trust, you'd have to file that form. If you're receiving distributions, you have to file that form. And then the 3520A looks at the underlying income and gains that are being realized annually within that trust, and provides a statement for the US owner to take those numbers to their tax return. And those forms are required. They're subject to penalties if they're not filed. They're expensive from a client compliance point, but again, important to get right. The income and gains that you take to the tax return, it is possible to then exclude that from US tax under Article 18.1 of the US tax treaty. I think the other downside that we see is that the types of investments that might be in these pensions are commonly classified as passive foreign investment from a US tax perspective, PFICs, which can add to the sort of complexity, really. Just in terms of making, I suppose all of this is trying to make it tax neutral with the UK tax treatment. So it's that, applying the treaty to get back to where you want to get to, but having to go through quite a few hoops along the way to get the reporting right.
Yeah.
If a SIP is not trust-based, then the alternative is that it's contract-based. Those ones are rarer. Often, as I said, we see the trust type plan. If a contract-based SIP is invested in funds that aren't publicly available, so they're only accessed via the SIP vehicle, then that plan can be treated as opaque. So it gets rid of the need to file 3520, 3520A. So worth having a conversation, I think, at the time of opening one of these plans to see if that's an option or not.
And is that something you could then set up with your investment manager? If they've got, awareness of this, would they be able to structure that for you alongside someone like yourself where you can get that all tidied up? Yeah.
Yes, definitely. Yeah.
Solutions. Nice. So often, as you mentioned right at the start, you end up picking up lots of little pensions on your during your career with different employers. As a US woman, you probably are just thinking, fine, I'm getting my new job, I've got my pension, that's all fine. But as we know, there's going to be some complexity there. What are some of the problems that this might create if you are collecting pensions during your career?
Collecting pensions, God, it sounds like a hobby, doesn't it? Hopefully no one goes out of their way to have the world's most pensions, but I think it's probably just a headache really for the individual themselves in terms of keeping track of all these things and all of the statements that get sent out, and just knowing the status of each pension from a US tax perspective starts to become a little bit complicated. Often the temptation, I think, in some situations is to consolidate these pensions into one pension. Yes, that can work, and for non-tax reasons may well be the way to go. But I think the key point I would raise there is that the actual transfer of pensions into one pension would be a taxable distribution from a US tax perspective, subject to treaty relief. So again, we can get out of it with the tax treaty because the UK wouldn't tax the transfer between plans. The other point there is that if you've got one that has been employer funded and employers been making contributions and salary sacrifice contributions have been going in, that nature of the contributions is lost on a transfer as well. So it does become a personally funded plan, and then you're back into what do I need to file the 3520, 3520A? Is it a trust? So it's not a no to do that, and I think it does. Certainly, if it was me, I'd be tempted to do that. But I think just understanding what's key on the US side, and taking advice in advance of doing that would be key.
Yeah, and I suppose HR or whoever sets up those pension plans is probably not going to be sort of flagging like, oh, they're a US connected employee. Oh, you need to go and speak to somebody. So again, I suppose there's some awareness that needs to come about from people who are employing US individuals to make note that there might be some additional complexities that they will need to deal with if they want to be helpful.
Yes. Yeah.
Anyone listening out there. So where do you most commonly see women discovering that they have been out of compliance? I suppose this isn't just applying to pensions, but just in general. And what does that situation typically involve?
Yeah, so I think, as I said before, when we take on a new client and we're looking at the previously filed returns, I suppose it's at that stage that we may identify that there are things that we want to correct and get right. So it may be that an amended tax return needs to go into the IRS to report some pension contributions or some growth. There's various sort of non-filer programs that the IRS has to enable clients quite effectively to get back into compliance. And if it's that FBARs haven't been filed in respect of pensions, or the 3520s haven't been filed, then there is a delinquent information return procedure available where you submit whatever's missing sort of under the normal rules, but with some sort of reasonable cause statement, which identifies the sort of facts of what's happened, how this has been missed, the fact that you've now taken advice, you understand that it's necessary, and that sort of helps to mitigate penalties. So I think it's important to get that statement right, to make it robust enough to come up and work against the IRS to mitigate the penalties. But I think that the sort of the main thing is to sort of get things right and get to them, I suppose, before they send out any notices.
Yeah, because not knowing isn't an option, is it? Saying you didn't know isn't going to get you off the hook. However, haven't the IRS recently, or they have set up a streamlined filing compliance procedure, which is one route back to it. How does that work? When is that the right option? Is that something that you do for your clients as well?
Yeah, so streamlined filing procedures have been available for a good number of years now. And I think, who knows at what point they may sort of get rid of those procedures, because the sort of focus was to get non-filers into compliance, and there were various other filing programs alongside Streamlined, but Streamlined itself is where there's been a failure to report foreign assets or pay taxes on foreign sources of income, and there has to be non-willful conduct involved. So it's not the program for someone who has sort of been deliberately tax evading and going out of their way to not report any of those things, which sometimes can be the case. But to qualify for those procedures, that it's certainly the foreign offshore procedures, there's, in addition to the non-willful element, there has to be the individual has to have been out of the US for more than 330 days in one of the 3 years previous to the years that they're filing. And then if they're eligible for that program, I think that the good news on that is that whilst they'll still have to pay any tax and be subject to interest on any tax that's due, they are protected from penalties. So it is attractive if there are lots of things that have been missed, if there's lots of catching up to do. Thinking about Streamlined is definitely one of the things that we would discuss with clients. They have to file 3 years tax returns to get back into compliance. So it's not a matter of, if someone has never filed a US tax return, but they should have been doing so for 25 years, they don't have to do 25 years of returns via this program. They just have to do 3 years and then 6 years of foreign bank account reporting. And then that gets submitted to the IRS with a streamlined certification statement, which outlines the facts and circumstances of the situation, why they're non-willful. And Sometimes it's necessary to instruct a lawyer to help with that statement, but we have many clients who have used that as a good facility to get back into compliance.
Wow. Yeah. I mean, a lot. And again, you know, if you're just totally uncharted waters, a lot of people, when they just haven't realized that they've accumulated this much complexity. So we are now quite familiar with this idea of a double taxation treaty. But we're now looking at retirement. When it comes to your pension withdrawals, what decisions can this impact and affect?
So I think, you know, at distribution, I would always recommend that the client is reaching out for financial advice at that time, as well as understanding the tax. You know, we're just talking about UK pensions today, but it may be that there's various US pension pots that also factor into things. So having a good financial advisor that's looking at the whole picture is obviously key to know which pot to take from first. And then it's largely going to depend on where that individual is resident at the time of the distribution, and how they plan to take distributions. So it may be that they want to take a lump sum payment from that pension, or they may want to take payments periodically over a longer period of time. And the tax treaty is different depending on the type of payment that they seek to take. Just to go over that quite briefly, the treatment for periodic payments, the primary taxing right is where that individual is resident. So if someone's resident in the UK, they're going to pay UK tax and take a credit in the US. Conversely, if they're resident in the US, then they'll pay US tax and then no UK tax. For lump sums, the UK has the primary taxing right, and there's been recent updates on some of this stuff with HMRC and the interaction of the tax treaty, and some clearer definition as to what a lump sum payment is for UK purposes. So that's one that's non-periodic, irregular, or abnormal. So if someone planned to take, say, 20% of their pension over a period of 5 years, whilst it might seem that they're taking 5 lump sums, it's actually classed as a periodic distribution because of the regularity of those payments. So yeah, I think the key is, where is the individual resident, and then how does the treaty impact that?
And so, okay, so with like a PCLS, the post commencement lump sum, what might would that trigger anything, or in particular?
Yeah, so that's the 25% tax-free lump sum in the UK. The treaty will honour that agreement. So for federal purposes, the US is also not going to tax that 25% tax-free lump sum. So in that scenario, you wouldn't have to report it as income on the return, but you would need a treaty disclosure statement which outlines the relevant treaty article 17(1)(b) that you're claiming in that situation, to make sure the US doesn't tax that. I think that's the tax treaty applies between the UK and the US from a federal tax perspective. So I think it's important there to consider, if someone is resident in the US, what state are they residing in? And does that throw up any complexity? Because there are certainly states out there that wouldn't honour that treatment, because the treaty doesn't apply from a state tax perspective. And so for California example, if you've got someone retiring back to California, then they would seek to tax 25%. So probably don't go to California in that situation.
Do that later. Do that after you've received the funds. Would there be a sort of a timeline on that? So say you wanted to receive the funds, being UK resident effectively, and taking your retirement in UK, but then you move. Does that matter? Is there a time limit? Like, you know, in 6 months?
No, it's just yeah, the US has a calendar year, and you're looking at what's happened in that calendar year. So so long as you time the move effectively so that it doesn't clash with an event like that, then you should be okay.
Yeah, should be. You never know. You never know. Change the rules again. Okay, so let's talk about actually how this might look for someone who's weighing up whether to retire in the UK or return to the US, or retain some flexibility what are some of the considerations that they would need to bear in mind with their UK pension?
Yeah, and I think it's going to be a look back at the history of the pension, really, and how it's been treated before. Is there any basis in that plan? Have foreign tax credits been used, or has the treaty been claimed? It certainly used to be the case, not a long time ago, but people could put a lot more money into pensions not so long ago, and foreign tax credits can carry forward for 10 years. So I had clients who had pensions with an awful lot of basis, and the plan was always to move back to the US. It was quite clear that that was the goal. So for someone, as we mentioned before, someone retiring in the US, if they've used the foreign tax credits on the way in, they've got full basis in the pension, for example, and then take out periodic payments from that plan, then they're not going to incur, whilst the US has the primary taxing right, they've got that basis there to protect them from the US tax. So, they could get a very good answer in that they're not really suffering any tax anywhere. So I think it's just critical to have that knowledge of what the, where the pensions are at in advance of taking the distribution. And as I said, the overall goal is to sort of minimize the global tax liability between the two countries, and be aware of any state tax considerations. It's not just as easy as saying, okay, I want to transfer my UK pensions into my US pension, because that just isn't possible because of the fact that these UK pensions are not qualifying from a US tax perspective. So there's no sort of chance to just move everything into a US pension if you do end up moving there.
Fun. Okay. Yeah, all these things to bear in mind. I guess let's go back to, if anybody is watching now and they are currently employed and they are contributing to their workplace pension in the UK, what do they need to keep in mind from a US perspective that their employer will probably not tell them?
Yes, well, I think we have to assume that perhaps, being a UK employer, they're not going to get too much help directly from them. So I think, all of the above considerations really probably come into play at some point. And I think, it's as I've said, understanding what the format of the contributions is and how they're being treated as they go along is crucial. Salary sacrifice plans are less, there's less compliance with a salary sacrifice plan. And most plans are salary sacrifice that I see these days. So that's quite helpful, to be honest. And keeping tabs, I suppose, on annual contributions so that you don't tip over that 50% mark. So you may have, say, 5% of your salary going into a pension and the employer matching that, and that's all fine. You've got 10% in there, but you still might have some, some way to make those contributions up to the level of the 60,000 that you can put in per tax year. So if you decide to make a personal contribution on top of that, what does that then mean? Does it tip you under the more than 50% employer funded and get a bit of a headache with more complexities on the US side? Your employer's not going to know the answer to that, but you do. Hopefully your US tax advisor does.
Well, okay, and one curveball, if you don't mind.
Yeah.
Because I know we're talking a lot about employees, but if you are a director of a company, say your own company, and you are US connected, would it make much difference in terms of what we are discussing? Or are there sort of better?
I don't think so. I think in that scenario, you've either got contributions going in via the company as an employer contribution, or you may have a plan that's completely outside of the company that, a SIP that you're running personally. So a lot of the things that we've talked about would still apply. you know, there's other benefits, I suppose, to making the contributions via the company just from a corporate tax perspective, and that may well be the way to go, but they wouldn't lose their status there as employer contributions.
Cool, thank you. And last but not least, at what point should an American woman in the UK be seeking specialist cross-border advice on her pension position?
I think definitely in the run-up to taking distributions. I think you know, that's the bigger event of the two is that, and you know, retirement brings with it a whole host of other things that are probably on the mind, but being clear as to if you're going to start taking some large chunks out of a pension, it will be all new. It's not something that you've done before. So I would definitely think at that point it would be something to think about, especially if there are multiple pension pots across the world to consider. But I think, you know, just annually being comfortable that these things are being looked at, being checked by the tax return preparer and reported correctly, so that there are no nasty surprises with penalties for non-compliance. So, you know, you don't need to seek huge advice. I think just being aware, being comfortable that things are being reported correctly will help you hopefully sleep well at night.
Brilliant. And
ignorance is also bliss.
Yeah, it is until you wake up. No, oh wow, thank you so much, Sarah. I mean, we've covered a lot, and for anybody who's watching this and is feeling a little bit bewildered or thinking this has triggered, you know, a prompt for a conversation, please do reach out. You're welcome to get in touch with me, and I'll put you in touch with Sarah, or reach out to her directly. But yeah, really appreciate you going through that so comprehensively with us. And it's something that, you know, more Americans are coming into the UK for obvious reasons, and I think there is going to be a lot more women who this is affecting, and men. This isn't, you know, we specialize for women, but you know, men, we will help you too. So yeah, no, really appreciate you sharing your knowledge with us, and for everybody who's tuning in as well.
Thanks, Lottie.
Thank you. See you soon. Bye bye.
Bye bye.